Hello, traders. This is Victor from TRADEPRO Academy. I hope everyone is doing well. And in today's video, we got a strategy-based video. So we're just going to be diving right into the screen here. Now, as you guessed it, based on title, what we're going to be talking about is an opening range breakout strategy on an options front, right? We're going to be talking about this from an options perspective and how we can identify these great potential running moves in the options world and in individual stocks, and how we can apply this to pretty much anything. So what we're going to be going through is what is the opening range, different ways to use it, risk management, how to play, and multiple examples. So let's list that off right after the intro, start step by step, and we'll dive right into this. But before we get into that intro, I want you guys to drop a comment down below. What kind of option strategy do you use and do you fall back on, right? Personally, I like this one. I like the volume profile as well. That's going to be one of my main trades, but the opening range breakout trade is amazing for momentum, and I'm going to show you exactly how to properly use it because a lot of people misuse the opening range breakout. So drop a comment down below, hit that like button, hit that subscribe button, and why don't we dive right into this? So throughout this video, what we're going to be talking about is breaking down what is the opening range. We're going to be going through how we can play this, right? We're going to be talking about option selection, trade management, looking at a few examples. Now, in front of me on the screen, you can see we do have Tesla, right? We can go to SPY, we can go to NVIDIA, right? We can go to anything and find out how we can actually use the opening range strategy to find amazing market opportunities. So first and foremost, what is the opening range strategy? We're going to be using a 5-minute opening range. So that means the first 5-minute candle is going to print a high and a low here on TradingView for us. Now, if we go into indicators here, we can easily add, we just type in ORB or opening range, and we can click this first one right here by triple Z Crypto 123, right? We can throw that one in there and we can identify what the opening range is. Now, if I look at this, right, I'll just get rid of this one. It'll show up with this green and red line. Now, we can look at a 5-minute opening range, and what I'm going to be doing is I'm going to be going from 9:30 to 9:35, and what that's going to do is print a extended line throughout the day's period at the top of the 5-minute candle and at the bottom of the 5-minute candle. So the caveat here is let the 5-minute candle close. Now, a lot of people can use, or do use, I should say, different denominations. 5-minute, 15-minute, and 30-minute is very popular, but I'm going to be showing you the 5-minute and how I like to operate with that. Now, the premise of the opening range strategy is that we will have a continuation break after we break out of this opening range. Whether it's to the upside or downside, we're going to be waiting for that to shape up, and we're going to be executing based on that. So if we get a break to the downside, right, we're going to be looking for that downside continuation that ideally flushes the market. And if we break to the upside, we're ideally going to be looking for an upside continuation that does the same. Now, there are a few caveats when we talk about the definition of the opening range strategy, and let's go through some of those, right? There are specific conditions that are required for the opening range and the breakout in itself, right? This isn't a type of strategy that you can do on a daily basis necessarily. It's not a type of strategy that allows you to do it on a daily basis, I should say, because there's a few different things that we have to consider. One of the main criteria is that we have to take into consideration what the prior day's range was, right? Were we within the prior day's range, right? Is that something that we can consider as a opening range type strategy, right? And what I mean by that is when you take the prior day's highs and lows, right? We'll just go with a horizontal ray here. We'll just use, let's start off with this day, right? We have, this is the high of this day, right? And this is the low of this day. Now, the next day down here, what happens is that we gap lower. So we are not opening back within the prior day's range, which happens to be on Tesla between this 219 and this 211. We actually opened somewhere in around 208, right? So that's the criteria number one. We have to be outside of the prior day's price range for us actually to use the opening range. Because think about it this way, right? When you're opening outside of the prior day's range, one of the sides of the market participants is getting stop run, right? Whether you're opening below or above, one side of the market participants, whoever's long or short, is getting a stop run. And that makes for a better and a larger trend continuation potential in the actual opening range trading strategy. Now, if we go day by day here, right, and the bottom end of this day's range happens to be in and around 206, and the top end, right, happens to be right around this 222. Right. The next day, this following day, we actually open above that area, meaning someone is getting stop hunted. Now, this is a day that we can use the opening range. Now, this following day is a very, very large, right, where we have from the top to the bottom, we have a very extended move of 226 to 204. The next day, right, it may not be that favorable to use the opening range. Now, the following day after that, right, we have the high is going to be in and around that 222 area, and the low is going to be somewhere down here at that 209. The following day, we do open above around 229. Yes, we can use the opening range. Now, finally, right, yesterday, 229, 230 is going to be the top end. The bottom end is going to be somewhere down here at 217. 2 days ago, we have this price daily range that is about like 13 points. We open within it. It is not favorable to use the opening range, and you can see we kind of just chop around. So that is one of the main criteria. Now, another criteria is, can we get a ferocious gap, right? Which could be an opportunity, right? Can we get a ferocious gap for us to continue somewhat of a movement that could help us identify, is the opening range plausible, right? And that goes hand in hand with opening in the prior prices range. So you have to keep that in mind. Can we meet those conditions for the opening range to be of use? So these gap setups, right, and opening outside of the prior day's price range is what we need for this opening range. And you can see here, we just did it on Tesla. We can take a look at it on SPY as well, right? On SPY here, we can go just day by day very simply. Starting with this day, right? The top here, we have the top, and then the bottom is down here, right? The next day we open within it, right? Correct. And it was a crappy just range day. So we just don't use the opening range. Now, this day right here, we have between 364, let's say, and then 368 is the top. We gap above. Okay, yes, let's use it, right? Amazing. And then right here, the top and the bottom of the price range day is somewhere here. We open back within it. Is it useful, right? Can we use the opening range? We might be able to, but it's not favorable in these market conditions that we just laid out. So remember, you want to keep those rules in check when you're thinking about using the opening range, right? It's not every day that we have the opportunity in that. So keep that in mind as we open today. It's something that we have to consider, because the top of yesterday was around 272-ish by a few cents, and the bottom was around 265.50 by a few cents. So we're going to open within the prior day's price range, meaning that, are we going to be using the opening range breakout? Probably not. We're going to let that kind of fester and sit without us, because we want to see an extended move that does run some stops. So now that we kind of broke that down, what is it? How do we look for it? We're going to have to break down, how are we going to actually play this? How are we going to play this opening range? Right, we can go back to Tesla here, because I like it. It's a little more volatile. Now, after the first 5-minute candle forms, you want to see where price is going to get triggered to the long side or the short side. So when it comes down to this, you want to see a break, right? A very convincing break. So let's look at this day, for example, right? You want to see, now there's a few different ways to play the opening range strategy, which we're going to break down in just a second. But we zoom in on this, right, on Tesla. Use this as an example. The low end of the move, right? 220, I don't even know what the level is. We can say around 224.90, right? 224.90 is the lower end, right? The higher end here is going to be around 230, just shy of 230, correct? So what you want to see is, after this first 5-minute candle forms, you have the top and the bottom that is extended for you based on this indicator that we used. And you're going to want to wait for a break down below or a break above. Now, there's risk naturally in the two ways that I'm going to do this and break this down for you. But essentially, what I want to see is a break under the low or above the high by, let's say, 10 plus cents. And I'm going to be looking to trigger my options position in that manner. Now, the risks, right? There is always the case where you break the opening range and you don't get a follow through naturally. So that's a possibility, undoubtedly. So there's two general ways to actually navigate this. Number one, right, you're risking the breakout and you have a very defined stop. You understand where your stop is. And let's say you have a stop halfway through, because realistically, if you have it back above this top, you're risking a large portion of the premium. So I kind of prefer kind of halfway through, maybe about 70% through of that opening range is going to be my risk tolerance for the breakout trade. Now, obviously, you're going to want to have something like a 1.5 or at least a 2 to 1. And of course, we're talking about options, and this is where it gets even trickier because there's a lot of different criteria that comes in this, right? There's a lot of variables that have to be taken into consideration. So for example, right, if you're short just below this and you have a 1 to 1 here, right? This is maybe midpoint. You'd ideally be taking your first profit somewhere here, right? And then your second profit looks somewhat of like a 2 to 1, which is somewhere here, so on and so forth. So realistically, right, when you do that breakout trade, you're risking that it just reverses back into the opening range, right? And this is one of the things that I mentioned that you want to see price actually open up away from the prior prices range, because it kind of mitigates this whole situation. And you have another option, another alternative is that when you get the actual opening range break, right, you let it break, let it do what it wants to do, and let it continue to show you that there's momentum in that direction. And then what you're going to be doing is looking for a pullback into the end of the opening range that actually broke out. So in this case, it's going to be the support, right? The lows of the opening range broke out. You let this thing extend. When it pulls back into that opening range low, this is where you're going to capitulate and look for that short to actually open up this position. Now, there's pluses and minuses to both of these sides, right? The first one, where you look for the clean break, there is the opportunity that it does pull back within the opening range, takes you out, and then maybe goes, right? Now, the other part is, if you're using the second portion where you're waiting for the pullback, you might not get a pullback if you miss the actual break. It might just start slumping without ever pulling back towards that opening range low. Now, obviously, it doesn't tick it to the exact tick, but once you start opening up a candle like this, right, you can qualify for yourself. Okay, this looks like an actual reversal candle. Let me try to get in on the next candle and see if we can pull this thing lower, because we know the general sentiment of the market is going to be lower because we're outside to the downside of that opening range. So keep that in mind. Now, the next thing that I do want to talk about here is option selection. This is where it gets even trickier, right? We're going to talk about trade management and option selection. First, option selection. When it comes to the option selection, you want to lean on something that trades more like the equity, because this is a very, very technical strategy. You're going to get a lot of movement if you select a short-term far out of the money option. I mean, a lot of movement in the price of the option itself, which can take you out before you actually see a real move. They'll lose value very quickly, and you might not get a chance to see that strategy actually work and that momentum actually shape out. So when you're considering day trading these strategies, consider trading the Friday expiration at the beginning of the week, right? You have a little more time, they're going to be a little more expensive. And potentially into the end of the week, once you get into the end of the week, consider trading the following week's, right, Friday expiration. Also consider Delta, right? Delta is going to help you navigate which strikes to pretty much select. And if you have a Delta reading of 30 to 40, right, you're going to be closer to the at the money options that do act a little more like the equity themselves, right? 50 plus, the deeper you get in the money, the more it is going to act like the equity. So just in case you have a technical stop loss, you're not risking random amounts each time, random percentages of your premium each time if you have something that acts a little more like the equity. That's why when I'm looking at the Delta and selecting the strike, right, 30 to 40, somewhere in that range, of course, they're going to be more expensive. But that's what it takes when you start trading this strategy. Now, before we take a look at a few examples, let's talk about trade management as well. This is one of the last parts. And when it comes to trade management, right, it's always going to be difficult to manage options trades, because options pricing models are going to be based on several outlying variables, right? We have Greeks, We have your deltas, right? We have your gammas. We have Vega, which isn't a Greek, but we have your thetas, right? You have all of these Greeks that affect, right? These are variables that affect how the price actually moves, right? If you have a super out the money, the delta is going to be super low, and you're not going to get that extended move. And when it pulls up a bit, right, this is going to lose value very quickly, right? Gamma is going to be the rate of change of the delta, right? That affects price very closely at the money. Vega, right, based on the volatility, but theta for day trading, right? You have a Friday expiration, you have a super far out the money, call or put, right? These are going to lose value very, very quickly if you're not getting that aggressive push. Now, if you have something that behaves more like an equity, it's going to behave more like this chart itself. So when you're selecting an option, you can mitigate the volatility of the options pricing, as I mentioned before, but also consider what stops look like from a technical level, right? This would change the risk of the options contract, however, because let's say we have at the 50% mark each time, right? 50 to 70% back within the opening range. This candle, number one, is going to be different each time, right? It's going to be a different size candle each time. Number two, when we have a technical perspective, this 50%, 70% based on the size of the candle can be 20% of the premium, can be 50% of the premium, can be 70% of the premium. So you have to have a hard stop on the premium itself that you're willing to lose realistically when you're day trading these. You have to keep that in mind. I usually go somewhere between a 20 and a 30% risk of my premium, keeping in mind where that might land on a technical level, right? This is where it gets a little more complicated, something that you'll have to figure out as you go along in your trading journey and as you go along with your strategies. Now, when I like to scale out, right, if I'm using something like a 20% stop, I'm going to be scaling out somewhere around 30 to 35% gain on the premium itself, right? So that's ideally a 2-to-1. If I have my stop here, that means I want my first profit somewhere here, right? Then here, whatever the case may be. So you always want to scale out, and I'm just going to scale out every 15% or so, right? So if I hit 30, the next 45, next 60, so on and so forth, right? So that's what I'm going to be looking for when I'm scaling out of these positions. And you want to scale out, especially when there's a momentum move and you have profit, because like I said, the variables in the options front, and especially day trade them, can really upset your positioning if it bounces away, especially if you're trading 0 days to expiry, which is not something that I highly recommend when you're trading this ORB with options. So keep that in mind. That also means if you're at a key support in the actual stock itself, in the equity, you're coming into a key support. And let's say right here, you have a 50% take profit. And you're like, I want this 50%, but you are at 45, you're at 42%. Understand that there is an equity area here that is probably going to reject price, which it does. And this 40% easily turns into 20, 15, on just this little bounce. So you have to understand that when you're near technical supports, you have to be scaling out and taking a lot of profit out of this market, because you get bounces like these and rejections like these that pull away from those profits. So with that being said, right, a larger, longer explanation, I do want to take a look at some examples and show you guys that these are possible, right? Based on the criteria that we've talked about. We can pick any random name, right? NVIDIA, I haven't even looked at these, and we can start identifying where those opportunities last, right? We can just pick a random section. Let's zoom out. So let's take a look at this, right? What's going on in this scenario right here? A very large gap lower. It's understandable realistically that we are not going to be in the prior day's range, right? Because the prior day range is here and here. We gap down here and we create this opening range. So it's not going to always be sunshine and rainbows, right? Because if we take a look at the first potential opening range trade, we said, let's say like 10 cents above the area. So the high of this move is going to be 126.61, the high of this move. So we barely miss it. We might have not even gotten triggered on this because it goes to 70, right? We want to make sure it's like just a bit above that. So even if we did get triggered, right, even in this first candle, because you can see the top is 52, the top here is 61. So maybe or maybe not you get triggered. You might take a stop on these. It's not 100% guaranteed of a strategy, right? You might be taking a stop on these. Now, on the other hand, you have this low. Because if we said that At this point, let's pick a midpoint here. I don't know exactly how big this range is. 126.38. So it's about $2, right? It's just shy of $2. So let's say somewhere at 125.50-ish, right? We have the midpoint of the opening range, right? When we're talking about NVIDIA, this is an example. So even if we do take it, I wouldn't have qualified this because I want 10 to 15 cents outside of that opening range for me to consider something here, right? So let's say we do take it, right? You take a stop, right? It doesn't mean every time that you see this thing shape up, you just take it. We finally drop, right? One of these is probably going to get triggered, right? Remember, this is where a stop is. One of these is probably going to get triggered. So let's say we have this position, right? We get triggered somewhere here, and we have our stop right over here, and our take profits, right? Take profit number one, right, is going to be somewhere in and around this area, right? That's going to be take profit number one. Take profit number one, right? You get it hit, great, pulls up, barely lose any value in the premium. Take profit number two is going to be somewhere here, right? It's going to be very deep into the end of the day. And if you do this correctly, you end up running the position for the majority of the day. Take profit number two, maybe 2.5 times, right? So it's going to be somewhere in this region, and then down to 3, somewhere down here, down to 3.5, right? And then the day's pretty much over. So this goes to show, right? It works on pretty much any name that you pick out. Of course, it's not going to be 100% because, it's not always an exact science. If it were, then I don't know, this probably strategy wouldn't exist or wouldn't work. You have to get some trapped people. But remember, we look at our criteria and we play it off that. If we pick a random other name, let's see, Amazon, why not? Right? These are larger caps that I do like to trade rather than these random ones. So Amazon here, for example, right? We're well outside of the prior day's range when we're looking at this specific opening range, right? You can trade. Maybe you trigger this. It probably prints something. I'm not saying it's no profit, but I don't know what kind of profit this might be. You might take some, you might get taken out, and you get back into the top of this range and you get triggered. Okay, you're in again, right? You get pulled back a little. That's fine. It doesn't really hit any of these stops, and we get this larger continuation throughout the day. The point is, you can take this and the criteria that we talked about today, where you don't want to be in the prior day's price range. You want to see some gaps, and you want to be 10 to 15 cents outside that opening range to actually trigger the position. So with those few qualifiers, everything that we talked about today, you can really bring about a very direct approach to day trading options and a very strong strategy behind it. And consider the things that we talked about. There was a lot of focus put on option selection and trade management because those are things that you do have to consider when trading, not only this strategy, but generally options day trades. So with that being said, I really hope you enjoy this strategy. I really hope this long-winded explanation got through to you and you understood something. And drop some comments down below if you're confused or if you have any questions based on this. Are you going to try out the opening range trading strategy? You let me know. And with that, smash that subscribe and like button, and we'll see you guys next time.